Imagine you land in a foreign country, say Japan. You hand over your 100 US dollars and suddenly you're holding a stack worth over 10,000 Japanese yen. For a moment you feel rich, but then you see the price of a coffee and it shows 500 yen. Back home the same coffee costs about $3. So why does the value of money change from one country to another? And why doesn't it stay the same? The answer actually starts with gold. For thousands of years, gold was money. Every civilization from ancient Egypt to medieval Europe trusted gold because it was rare, durable, and people agreed it had value. But carrying gold everywhere was heavy, risky, and impractical, so governments built vaults, stored the gold, and issued paper notes in its place. Each note represented a fixed amount of gold, and this concept is called as the gold standard. Because money was tied to this physical commodity, governments couldn't simply create more money unless they increased their gold reserves. That constraint kept exchange rates relatively stable. But as the global economy expanded, there just wasn't enough gold to go around, and this made countries hard to recover against crises or to fund wars. So later, by the 1970s, when United States suspended its dollar convertibility to gold, the term fiat money came into our life. Fiat in Latin stands for let it be done. In terms of fiat money, the paper in your wallet now has value because the government decrees that it does and you and I believe in them. If everyone wants a country's currency, its value increases. If everyone wants out, it weakens. This is supply and demand in action. And honestly, that part hasn't changed since the days of the gold standard. But here's where fiat money hits different. Unlike gold, it has no natural limit. And because of that, currency strength and weakness now depend on things like inflation, interest rates, and other government policies. Now let's look at how these major forces determines the currency's strength and how each country's government influences them. The first of these forces is inflation. Inflation happens when too much money is chasing too few goods. A loaf of bread that cost $1 in 2022 may now cost $2.5 because of inflation. When a country prints too much money, the value of each dollar or pound decreases. Think of it this way, if everyone suddenly had twice as much money, prices would simply rise to match. You would have more money but less purchasing power. This is why excessive money printing weakens a currency, makes imports more expensive, and hurts everyday citizens the most. In extreme cases, inflation can destroy a currency entirely. For example, in the early 1980s, one Zimbabwe dollar was worth more than a US dollar. But they had a poor record of its mismanagement and excessive money creation, so hyperinflation took over. Prices doubled almost daily, and the governments eventually printed a $100 trillion note just to keep up. Zimbabwe ultimately abandoned their currency and adopted foreign currencies, including the US dollar, which restored price stability, but the government could no longer print money freely. When other countries use the US dollar, the United States benefits in a unique way. It costs only a few cents to print a dollar bill, yet that bill can be exchanged for goods and service at a full face value. Essentially, the US gets real value in return for paper it prints at almost no cost. This is called seigniorage. The second force is interest rates. Interest rates are simply the cost of borrowing money, but they are also the reward for saving it. Imagine you have savings to invest. Country A's government bonds pay 1% per year, country B's government bonds pay 5%. If both governments seem stable, where would you put your money? Most people would choose country B to earn the higher return. But to buy country B's government bonds, you must buy country B's currency. If investors around the world starting doing this at the same time, demand for that currency increases and its value rises. However, investors must remain cautious because past performance is never a guarantee for future returns. The third force is the trade itself. Consider a country like South Korea that exports manufacturing goods like smartphones to cars to advanced semiconductors. When other countries want to import these goods, they cannot pay South Korean factory workers in US dollars or euros. So they go into the foreign exchange market, sell their own currency, and buy the South Korean won to complete the deal. The more a country exports, the more the world is forced to buy its currency, which keeps it stable. These trade flows happens only a few times a year. But you might have noticed that the currency's value don't stay the same and the value changes literally 1,000 times per day. What is the reason? Well, it's simply the bets placed by day traders, hedge funds, and algorithms against these exchange values. Some countries find these floating currencies stressful and volatile, so they choose to peg their currency to a more stable one. For example, the UAE pegged its dirham to the US dollar at a fixed rate of 3.67 to 1. This brings stability and predictability, especially for trade and investment. But pegging comes at a cost. By tying their currency to another one, a country surrenders control over its own monetary policy. If the US dollar drops, the dirham drops with it. If the US raises its interest rates, the UAE may be forced to follow even if its own economy doesn't need it. If all these factors seems overwhelming to us, then a natural question arises. Why not just we have one single currency like a world dollar to solve these issues? Well, actually euro functions similar to the world dollar concept but for Europeans. Euro is incredibly convenient for people living in Europe to travel and trade. But the problem is every single country in the eurozone must give away their monetary control to the European Central Bank. This means that a country can no longer lower its own interest rates to fix a local recession. If the entire world uses one currency, one country's financial mistake could instantly become a global catastrophe. We need different currencies because different countries have vastly different economic needs at different times. Now all the economic forces we discussed begs a question. Should a country make its currency as strong as possible? The answer is not necessarily. Different countries have different needs. Countries like the United States or Britain import more, so they keep their currency stronger to buy goods cheaply. Whereas countries like China or South Korea export more than they import, so they keep their currency weaker to make their goods accessible to a wide range of markets. So next time you check these numbers on a screen or in an app, remember that they reflect the country's money supply, interest rates, physical goods, trust, and live forex trading all at once. If you are interested in understanding why different currencies actually exist, let me know in the comments below. Thanks for watching.